Hello, everybody, and welcome to the pilot of Open Interest, where we will address topics in a more interactive manner and in greater depth than conventional business news permits. So please be sure to participate in the comments. Today's main topic, inflation. We will take some questions. We also have a poll. Today's poll question is, do you think inflation will cause a bear market? Subscribers can vote in the comments by entering a number from 1 to 5, where 5 means you strongly agree, 1 means you strongly disagree. If your view changes as the program progresses, or if you enter a number in error, you can respond again. Only your most recent response will count. Joining me today, my good friend, co-author of The Options Edge, chartered financial analyst and professor at Rutgers University, Mark Guthner. Welcome. I'm not sure if I hear Mark. Maybe the director can tell me. Do we hear Mark? Okay, so we are going to try to sort that issue out. I suspect what's going on. Oh, you need to just do that same tinkering with your microphone that you did once before, Mark. This is the beauty of the pilot episode, that we're going to try to work the kinks out here. But his microphone has had some issues this morning, so we're going to try.
How about that?
That works a whole lot better. How are you today, Mark?
Very good. Sorry about that. Technology, when it works, it's great. When it doesn't, it's a nightmare. But that aside, I'm pretty energized to be here.
Okay, great. So, Mark, today's topic, we're talking about rates and inflation. And I think this is a topic that has been touched on quite a lot. People have noticed, I think, that inflation has been rising. I think people have obviously recognized the fact that interest rates are at lows, that maybe historic lows. You have experience managing bond portfolios, a lot more experience on the fixed income side than I possess. So I was kind of hoping that maybe you could address this, and I'll throw up some charts so you can kind of put this whole conversation into some context for us. So why don't you go ahead?
Okay, sure. So one of the things I like to think about with interest rates is they tend to go in these big, long waves. So rates, will rise over 50 years, 60 years, and then go through this big downswing. We've been living through this downswing ever since interest rates peaked in 1981, 1982 kind of time period. But preceding that, starting in the mid-30s, rates bottomed at rates not too much higher than they are today, and then ran up into the mid-teens, at least the 10-year did, and took a long time to get there, and now it's taking a long time to come all the way back down again.
I mean, and just to, you say back down again. I mean, isn't it safe to say that right now these are historic lows, right? We've never seen.
These are historic. Yes, these are historic lows. Not only did rates get down to where they were in the 30s and early 40s, but have gone below that. And I would dare say the interest rates have never been this low in the history of the U.S., or at least a few months ago when Treasury bills hit zero and the 10-year bond was in that 1% range.
I mean, isn't it also true, though, that we've lately been seeing an uptick in inflation? And how should that be playing into this?
Yeah, so inflation and the interest rates kind of follow this same cycle. So I think interest rates are probably bottoming because inflation is most likely bottoming. And the Fed has tried very hard ever since the financial crisis in 2009 and the following years to not let deflation happen in the economy. And so I think they've kind of built up some inflationary pressures. And they really went all out once, the COVID thing hit, because 40% of all the money ever created in the U.S. was created in the past 2 years, post-COVID. So higher money, more money, eventually is going to lead to higher inflation. At least that's what the monetary theory of money tells us.
I mean, isn't it true now? I mean, given where inflation is, and I think this is the challenge that all investors are really facing, it's you can't really keep any money in cash, right? In the current environment. And then other assets are also looking a little bit challenging.
Yes, and and I would say this is a bit of a shame because most of us want to get up, go to work, do our jobs, but when we have these inflationary environments, we need a second career, and that is to be a fairly savvy investor to figure out what kind of investments to move your savings into. So you can't leave it in a bank. So you've got to buy stocks and you've got to buy real estate. On the plus side, we have a lot of index funds, and you can just buy the S&P 500, or you can buy an index of real estate investment trusts and go about your business. But nonetheless, you've got to take the ups and downs.
Yeah. So I guess my next question would be, I mean, you were just sort of touching on the fact that the Fed has expanded its balance sheet, that there's been a lot of money creation. How big has that money creation been?
It's been extraordinary. So if we go back and we look at the supply of money, or let's as a proxy for that, the size of the Fed's balance sheet in 2007, it was a little less than $1 trillion. And then they started quantitative easing and increased their balance sheet. And they do that by issuing currency and then buying U.S. Treasury bonds primarily, and mortgage-backed securities secondarily. And so they did that continuously until about 2018. And then they wanted to taper. They wanted to start selling some of those securities, but we had a problem. We had a bit of a taper tantrum. Then COVID hit, and then ever since COVID hit, they've more than doubled the supply or the size of their balance sheet in just 18 months. It's extraordinary.
Yeah, I think that brings up an interesting question, which is that we've seen some signals recently from the Fed. Powell's most recent comments probably were the first to really acknowledge that inflation is a consideration and a potential problem. But the suggested policy response is, and what they've been saying they would do, is simply slowing the rate of purchases, not reducing the size of the balance sheet. Do you think a reduction in the size of the Fed's balance sheet is likely, or do you think it's even possible at this time?
I don't really think it's possible. They've got everybody addicted to borrowed money. So corporations have levered up their balance sheets. The federal government has levered up its balance sheet. Individuals have done the same by paying up a lot for houses. We're seeing a boom in housing prices as people are running like mad to try to lock in their housing expense by purchasing a home. And so I think we've seen in the past year the price of a typical house rising somewhere between 15 and 18%. So I don't know how they taper in that kind of environment, because they've got everybody sort of really locked into a lot of financial leverage. And they kind of need easy money and low interest rates to keep that game going.
So I guess the question that comes out of this, I mean, obviously the way some consumers are responding to what's going on, the very low rates, perceptions about increasing inflation is to try to take advantage of that low rate situation, and also probably some fear that inflation could creep into the major purchases that they need to make, like buying a house. But for investors, this kind of leaves us in a really strange dilemma, doesn't it? I mean, what is the trade out of all of this? I mean, we have a couple different things one could do. I mean, you can keep money in cash, you can buy fixed income, you could buy long dated or short dated, you could invest in commodities. Equities obviously have been on a tremendous tear, probably because they're perceived to be a better place to be than fixed income, and certainly than cash. Cryptocurrencies are another. So I guess my question, and some people who might be viewing this video probably unaware that you actually know a bit about cryptocurrencies, and in the fintech lab that you started at Rutgers, you're mining several of them. But that's really the question we need to ask and try to answer. What do you buy?
Well, the number one thing that investors should not do is buy long-term bonds. Um, Interest rates are only going to rise from here, and the value of those bonds are going to fall, or at least in my perspective. So the worst thing that you can do is buy 20-year or 30-year bonds. So let's put that aside. And if you need a little bit of income or stability to your portfolio, stick to 5-year bonds or shorter duration, because if rates do rise, you'll be able to roll over those bonds at a higher interest rate.
So
that's number one.
Yeah, it's interesting that you mentioned being in shorter term bonds. One of the things that I heard Jeff Gundlach say recently was that he thought that an allocation of a portfolio might be 25% in bonds. One of the things he actually mentioned, though, was that he was saying that even some allocation to long-term bonds might make sense if we get into an environment where they try to pressure the long end of the rate curve anyway, because in that circumstance, you actually could see some capital appreciation in bonds. And I think he was thinking of this as a little bit of a hedge. What do you think of that?
I think from his perspective, he's a active bond portfolio manager. He's got a huge amount of assets under management. And so should he want to play the wiggle, and he's sitting in front of a computer screen all day, he can make that trade. But I think for the individual who's trying to set up a portfolio and then let it do its work, I don't think that makes a whole lot of sense. So it depends upon who you are.
And what do you, you've obviously, I've been in the business over 20 years. You've been in it a little bit longer than I have. One of the things people keep pointing to is that equity valuations seem very, very high. So if we take a look at trailing 10-year corporate earnings, Robert Shiller likes to talk about his CAPE numbers. And if we take a look at forward earnings, there too, equities look expensive relative to themselves. But are they expensive relative to the alternatives where you would invest your money right now?
Well, risk assets like real estate and like stocks are valued relative to bonds. So since they are more risky than bonds, they should provide a higher rate of return. But if you think about what intrinsic value is, and this is the approach that Warren Buffett takes and other value investors take, is they're looking for a stream of cash flows to come from a corporation. And if the stream of that cash flows, let's say, is worth $100 because interest rates are at 3%, why the value of that stream of cash flows might only be $50 or $60 if we're in a 5, 6, or 7% interest rate environment. So the stock prices are going to follow interest rates. So if interest rates go up, I would expect equity prices to fall, and real estate to be under pressure as well.
Okay, so with that, I think maybe we might try to take a look at some viewer questions here, and I see that we have a couple. So let's see here. I'm going to see if I can grab this one. Brad Holt is asking us, at open interest, will interest rates rising today even influence inflation with so much money printed? So I guess what he's asking is, given the fact that the money supply has expanded so much, and by the way, it's worth noting that, and this is just a comment I'll throw in here, the Fed's effective money printing through the form of quantitative easing with its open market activities by buying bonds is not the only mechanism by which money is created, is it? So that's one part of it, but it's only one part of it.
Yeah, well, banks create money as well, or they create credit. You want to take out a loan, they'll loan you some money, and they make a deposit in your account, and money is is produced in that. You can go out and spend that money in that process. I think the important thing to keep your eye on is monetary theory tells us that money supply growth has an effect on the economy and prices with a lag. So typically, the Fed will increase the money supply, and 18 months later, we start to see some inflation. We kind of got away with that cycle stretching out, if you will, after the financial crisis because people were, very timid and didn't want to spend money. They were, shocked by what happened, and people became more conservative and increased their savings. But I think the horse is out of the barn now, and so that's going to begin to change people's psychology. That they might want to go spend money now before prices go up, and that becomes a little bit circular. And once inflation starts, it's tough to break that psychology.
Yeah, I think he's asking us a follow-up question too, which is, is Bitcoin or cryptos in general, and we've seen, for example, Ethereum massively outperform Bitcoin this year. Is it a good hedge against authoritarianism? I'm not sure if we're going to be able to answer that question, or even if one should. And wild monetary policy. One of the things that I think we saw, obviously the market has done well over the last couple of days. We saw a bit of a swoon. Cryptos seem to get carried along with that. So it seems that there's a correlation with cryptos as a risk asset. If stocks get hit, it appears, at least in the short term, that cryptocurrencies are similarly being hit, which also begs the question, is there a safer haven with lower volatility than cryptos possess? But do you think they're a good hedge against this type of monetary policy? And do we think that there's some risk that people who influence monetary policy are concerned about cryptos and might do something to stop them?
Well, I would say a couple of things. One is some have argued that cryptos or Bitcoin is a safe haven asset, and I reject that notion. It's a risk asset, and it's a risky asset, and its price goes up and down, and it is becoming more correlated with equities. I think it's going to have a more upward bias than equities. So, it's not a security that can be printed. So if the price goes up a lot, there's not going to be magically a whole bunch more of them. So it's
well, that depends on the crypto. That does depend on the crypto, though, a little bit, doesn't it? We're not talking about Dogecoin.
I'm focusing on Bitcoin and Ethereum, where the supply, Ethereum grows really slow, and they're making some changes to the protocol that may bring that to a near halt. But Bitcoin, there can only be 21 million eventually, and then that will be it. So they can't make more. And I think it's at this stage of the game the granddaddy and the one that's most likely to become sort of an international monetary asset.
So one other question is, with rates this low, does it make sense to stop renting and buy if one is a renter? I think you kind of hinted at or alluded to the fact that rising interest rates and rising inflation is obviously a support for real estate as a real asset, but rising interest rates might make it a little bit of a double-edged sword if rates rise in response to inflation, right?
Yes, and I've always told people and my students that if you're going to live someplace for a long time, then timing the market is not very important. If you're going to buy a house and live there for 20, 25 years, buy the house. It's a different story if you think you're going to buy it and then you're going to have to move in 2 or 3 or 4 years. You'll be subject to the short-term whims of that market, and we saw in 2008 that it is possible for real estate to fall pretty sharply if the wheels fall off. So it's a tough question, and I think it boils down to your horizon on the length of your horizon on where you're going to live.
Okay, so I know we were only going to give this about a half an hour, and we've at this point used up most of it. But I think for anybody who's viewing this live, or for anybody who might view it in the future, arguably the biggest and most important question is, if you hold equities, should you sell them? And so that's certainly one of the considerations that we have to have. And what would you say to that? I mean, or does it make some sense to continue to hold equities but find a mechanism to potentially hedge them? Because one of the things we saw in this most recent swoon, we saw a big uptick in implied volatility. And even as the market began to recover, the prices of options didn't drop as much as they normally do. And by the way, just so that people have a sense of this, when the S&P drops about 1%, generally the relationship is that the VIX will rise by a percentage point. So, for example, if the state of the world is that the VIX is 18, and you see the S&P drop by about 100 basis points intraday, we would normally expect the VIX to rise by about 1% to 19. But in fact, what we saw most recently was with the S&P only 4% off of its all-time highs, we saw an intraday high. That was on that Friday where we saw that swoon. The VIX was over 35 and closed above 30, and it didn't really come in much. It's much lower now, though. Is now a good time to think about putting on a hedge?
I do, and I wouldn't think in terms of selling all my stocks or anything like that, but you might want to lighten up, and I certainly wouldn't be owning stocks on margin. And there are good ways for you to hedge. Some people just like to buy a put option. Others like more sophisticated strategies, some which we've talked about on our website, theoptionsedge.com, but one being a ratio put spread where one buys two, let's say, out of the money put options and pays for it by selling one near the money put option. And that's really provides you with crash protection. If the stock market really gets hammered, that position will do just fine. If the stock market kind of hangs up and maybe rises a bit, you probably break even or you lose just a smidge. So it's a nice hedge. But we like to think about and talk about some alternative structures that make some sense to minimize your loss if you turn out to be wrong.
So ratio put spreads, a lot of people sometimes will buy a higher strike put and sell two lower strike ones. And the reason they do that is because they want to finance near protection. But you're kind of thinking about this a little bit differently. You're thinking that you want to buy the dips, maybe sell the rips, but own crash protection if that dip proves to be something more dangerous. So you would actually sell the one and buy the two to have the protection against a real severe downward move, but you're willing to take some minimal exposure if the market falls 5, 6, 7%. Is that right?
Yeah, that's right. And I'm just thinking about that because look at the S&P has more than doubled since the COVID bottom. I think valuation is stretched, and I think this is why we're getting these big 500 Dow point swoons, as I think a lot of professional investors know that valuation is extended, and but they're playing a bit of a game of musical chairs. It makes no sense to hold cash because of inflation. You're losing your purchasing power, so you're trying to stay fully invested, and but you know that there'll come a time where a 20%, 25% correction may come along, and you're trying to avoid that. So when things start to turn down, we get these quick swoons as everybody runs to the exit, and I think that's kind of where we are. And I think people, I think there's a bit of crash risk in the market, but these are super small probabilities. But nonetheless, if you wanted to hedge against that kind of thing, then the ratio put spread makes sense.
All right. Well, Mark, I think that's about all the time that we have. I'm really glad you were able to join me today and look forward to doing the next one. For those of you who did join us today, thank you for that. And we look forward to your participation in the future. And for those who are seeing this in a recorded fashion, please be sure to tune in for our next one. We're really looking forward to making this a regular thing and adding it essentially to the pieces that we typically write and publish on the optionsedge.com website. And of course, we encourage participation, we encourage comments, because then we can respond to the things that are of interest to you. Thanks everybody for participating. We look forward to the next one.
Bye, everybody.
If you liked the content, please consider subscribing to the Open Interest YouTube channel. That's youtube.com/open interest. And of course, you can also follow or tweet me at Michael_Khouw, or go to our website, www.openinterest.pro.